and you get the tax allocation wrong, it could cost you thousands. Here's what you need to know. Hi, I'm Dazley from CMK Accountants, and today we're talking about something that affects every property transaction in New Zealand, but that most people have never heard of. It's the tax allocation rules in sale and purchase agreements. These rules changed in 2021 and they could significantly impact your next property deal. Whether you're a farmer, business owner or property investor, this affects you. So here's what was happening. People were manipulating how they were allocating the purchase price between different assets to minimise their tax. For example, they'd agree on one allocation in the sale and purchase agreement but use completely different figures in their tax returns. The IRD got fed up with this, and rightly so. They introduced strict new rules. Now if you get this wrong, you could face audits, penalties and significant additional tax. Let me break down the new rules. Section GC20. If you and the other party agree on an allocation before filing a tax return, then you must use that allocation. No exceptions, no minimum thresholds, you just must use it. Section GC21. If there's no agreed allocation, then the vendor has 3 months to determine it and notify both the purchaser and the IRD of the values they are using. Now there are some relief provisions. The $1 million transaction threshold means that smaller deals have more flexibility and there's protection for small assets under 10 grand. But here's the crucial part. Everything must be allocated at market value. The IRD has the power to challenge your allocations if they don't reflect genuine market values. So let's look at a practical example. You're selling a commercial building for $1.5 million. You need to allocate amounts between the land, the building structure and any plant and equipment, and of course the fit out. If you allocate too much to the depreciable assets, like fit out, to give your buyer higher depreciation claims, the IRD could challenge this if it doesn't really reflect market reality. So what should you do? First, get professional valuations for significant transactions. Second, document your allocation methodology clearly in sale and purchase agreements. Third, seek professional advice, especially for complex properties. And fourth, remember those time limits if no allocation has been agreed. These rules are complex, but they're designed to ensure the fairness in the tax system. The key is getting it right from the start rather than trying to fix a problem later. If you're planning a property transaction and need help with tax allocations, contact one of the team at CMK Accountants. We specialise in rural agricultural advisory services and can guide you through these requirements of the allocation rules. Don't forget to subscribe for more tax and business tips specifically for New Zealand farmers and business owners. We'll see you next time.